Look, inflation's going down, and it's going down fast. And the only thing left in CPI that's keeping it even modestly high is rent. And rents have now fallen 7 months in a row. So, but used car prices have collapsed. They've gone, to be honest, you've seen Tesla car prices. Holy crap, used car. You don't want to have to sell your Tesla. Driving it, pretty good, but don't try to sell it. But used car prices generally are down, and oil prices have collapsed and year over year had negative impact on inflation. So I think there's going to be more talk of deflation. So, one of our surprises was there's no impetus for rate cuts at all.
After grappling with high inflation for more than 2 years, American consumers are now seeing an economic trend that many might only dimly remember: falling prices, but only on certain types of products. These items are products such as used cars, furniture, and appliances, which saw big run-ups in prices during the pandemic. Used cars in particular were a pain point for U.S. households, with pre-owned cars seeing their prices jump more than 50% in the first 2 years of the pandemic. These recent pockets of deflation could help push the overall U.S. inflation rate closer to 2%, which is the level the Federal Reserve is targeting. The central bank has raised its benchmark rate 11 times since early 2022, part of its plan to make it more expensive for consumers and businesses to buy homes, autos, and other items that are purchased with loans or credit. Mark Yusko dives into the macroeconomic indicators, pointing out his stance on the economic standpoint of deflation rather than inflation. He also discusses it in detail, including the Fed fund rate and the possibility of an interest rate hike, which he doesn't see any possibility of. Let us now get into the video, and make sure to like the video, subscribe, and drop your comments below.
That shelter component is now the largest component, and it's nosediving, and it's gonna continue. There's way too much supply, particularly of multifamily getting built. I mean, you drive around Chapel Hill where I live, thousands of apartments being built. I mean, thousands, and they're, you drive by them at night and they're just dark. So that rents are coming down, but the thing that's just not being talked about enough, the money supply growth, both in the US but also globally, is contracting at the fastest rate ever.
Really?
Ever.
I didn't realize
we
that.
just beat the 1929 print. It is literally, it's like, through the bottom, like, of the screen, like my fingers going off the screen. I mean, it's through the bottom of the graph. And look, we needed to do that because they made a mistake in 2020, and, the cult of Keltonites, they created too much money and it went into everything, right? We've talked about this. My home did not appreciate. My home didn't get better. It actually wore out, but the price went up because the money got less good. And so they got to fix that. And I mean, again, on the way back from Pinehurst, my wife and I stopped, and we got one sandwich to split at this amazing place called Merritt's in town that does these amazing BLTs. It was $20 for one person. I mean, it was two people because we split it, but $20 for a sandwich? There's a mechanism that I can't describe well without kind of looking at a picture, but deficit spending certainly is a component. So fiscal is certainly a component of the demand for the creation of money. But the other side of it is the monetary policy, which has to do with loan demand and loan creation. Bank lending went negative for the first time in 70 years, 60 years. I can't remember the exact period. But that's a huge part of it, the money and credit creation. And then there's a multiplier effect. And again, I don't want to speak out of school because, although I do that a lot, but I'm close enough. I'll just talk about it. But here, there's so many parts to the actual M2 money supply, but a big chunk of it is you create the money, but then there's a multiplier effect because of credit, and that is collapsing. It's collapsing. And the velocity of money comes in here too, and the velocity is like plumbing new lows.
Businesses, especially at the smaller end of the spectrum, rely on a constant flow of fresh capital to grow and expand. That might come in the form of debt financing or even equity financing, where a business is selling a stake in its future. A business's borrowing power shrinks as rates increase because serviceability costs occupy a larger share of its income. Similarly, the business might attract less revenue when rates are high because its customers have less disposable income, and that impacts how a potential equity investor calculates its valuation. That's one reason many technology and software stocks have plunged since late 2021. Mark Yusko now further talks about the Fed fund rate, interest rate, and why he calls a zero probability as related to the Fed further cutting rates this year. Let us hear what he has to say about that.
You think
There's
so?
zero probability. And what's amazing, it's 5.5. I'm not sure how you get a half, but it's 5.5 are priced in. And starting, in March, which means every meeting in the year, there would have to be a rate cut. No way that's happening. The one that got me though, Michael, was 2024, the dot plot. So today the dot plot is perfect. We're 5.5. Okay, great. But then by the end of this year, the dot plot had spread about 150 basis points, from highest to lowest. By the end of 25, there was one governor who said, we're going to be at 5.375. And there was another one that said we're going to be at 2.375. Like, do you know something that I don't? I mean, you're telling me we need to go back to global financial crisis-esque rates within 24 months? Yet I thought we had the greatest economy ever. I thought there was no chance of recession. I mean, why would we go to 2.375? Now, unless they finally realized, we can't afford, I think the new number is $967 billion of interest on the debt this year, and 21% of the debt has to be refinanced. So that number is going to go up. So maybe that's why they're going to be forced to cut. That's interesting. So I'm going to take the under. I'm probably going to be wrong, but that's what I'm going to take.
Probably.
You don't have to care until you do. Right. That's the way it works. You don't care, and then you do. And that's how it's always worked. And if you go back in history, it doesn't happen very often, but those collapses, when they happen, they're ugly, right? Whether it's Weimar, whether it's, 1929 to 33, it doesn't happen very often, but yeah, it's ugly. And so, yeah, you're right. You don't have to worry that there's $34 trillion of debt. Well, it's not debt, because if you're never going to pay it back, then it's not really debt. Debt actually is an instrument that two people exchange with the expectation of paying principal and interest, right? That's a bond. That ain't what this is. This is an accounting entry that's like, just don't worry. Just don't open the closet. It's like when you have a closet that's totally full and you put the last thing in, just don't open the door and you'll be fine. But if you forget and you open the door, you're buried. And that's where we are.
U.S. consumer prices rose 3.4% annually to close out 2023, capping a year of substantial progress on efforts to rein in painfully high inflation. The Consumer Price Index, which measures the average price changes for commonly purchased goods and services, rose 0.3% in December from the month before, matching expectations, according to Bureau of Labor Statistics data released Thursday. The monthly and annual numbers for December were higher than those seen in November, when tumbling gas prices drove the overall index lower. In December, gas prices stayed mostly neutral, rising 0.2%, while rising shelter costs accounted for more than half of the monthly all-items increase, according to the BLS report. Economists were expecting the annual overall inflation rate to tick higher, to 3.2% from the 3.1% headline reading the month before, according to FactSet consensus estimates. Despite the acceleration, the annual rate of consumer-level inflation is down considerably from December 2022's rate of 6.5%. Additionally, a closely watched measure of underlying inflation slowed further. When removing the more volatile categories of food, which increased 0.2% on the month, and energy, which ticked up 0.4%, core CPI measured 3.9% annually, a step back from November's 4% reading and the lowest annual increase that index has seen since May 2021. On a monthly basis, core CPI rose 0.3%, in line with expectations. What does this mean for the Fed's rate cut plans? Thursday's report, at first glance, appears to be yet another example of the long and bumpy process to bring down inflation. However, when annualizing the recent month's data, the latest CPI report shows continued progress toward what the Federal Reserve would like to see. Still, December's report likely means that the Fed will keep interest rates steady at its meeting later this month and in March, and pushes back any rate-cutting action until further in the year, economists said. Do you think we may see sporadic rate cuts like last year once the Fed starts cutting rates? Let us hear your thoughts in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.
Hey Savvy Finance enthusiasts, massive shout out for being the heartbeat of Savvy Finance. Your support has been the wind beneath our wings, and we can't express our gratitude enough. Now buckle up because we've got an exclusive deal just for you. Ever wanted a slice of the action? We're offering a golden opportunity to own part of our YouTube channel's potential future revenue. This isn't just an investment, it's an invitation to be a part of our story. Investing means you're not just an investor, you will be a participant in the future of Savvy Finance. No cheesy lines, just a genuine call to embark on this journey together. But wait, there's more. Your mission, should you choose to accept it, become a Savvy ambassador. Share our videos on every platform: Facebook, Twitter, LinkedIn. Your shares amplify our visibility, potentially translating to more views and more YouTube revenue. Here's the kicker. If our viewership increases, we would not be just growing financially. We would be making a tangible impact by spreading valuable financial education. Now the icing on the cake. Invest and you'll score exclusive access to our private Savvy Finance Discord. Here you can chat with Savvy Finance, swap ideas with fellow investors, and be at the forefront of exciting developments. Click on the link below to register your Gigastar account. You can also find the link to my offering page in the description below. Get your Gigastar account ready, review the offering details, and let's embark on this thrilling venture together. To the incredible Savvy community, thank you for being the backbone of our success. Your journey is my journey, and together, we're creating waves. Cheers.